Pinduoduo stock plummeted 13% yesterday after a shocking Q1 2025 earnings report. Revenue miss, earnings miss. The headlines look grim, and a lot of PDD shareholders are understandably concerned. Many are asking if this is a sign of deeper problems. But is this the full story? We have been discussing a paradigm shift for Pinduoduo on this channel, moving from hypergrowth to more sustainably steady growth, much like Alibaba. This report might just be the wake-up call that confirms it. So, before you think about selling, or if you are looking at this dip and wondering if it's a massive buying opportunity, you absolutely need to watch this video. We are going to break down what this Q1 report really means, why PDD's fundamentals and valuation could still be incredibly attractive for investors, and discuss that huge cash pile they are sitting on. Don't go anywhere. Starting with the earnings numbers, the first key takeaway was analysts were way off in their estimates, especially in the earnings per share. Revenue, it was expected to be 14.2 and it was reported $13.3 billion, 7% below estimates, almost $1 billion below. Earnings per share, the estimates was 2.6 and it was reported 1.58, which was 40% below. That's probably why the stock tanked 13% yesterday. In my opinion, earnings per share miss of 40%. It's not bad news for me as a Pinduoduo shareholder, because management team of Pinduoduo has been warning investors in the previous earnings report that they will be investing a lot, they will be spending a lot of money, and profitability will take a hit in the next few quarters, possible a year. So it was expected in my opinion, but revenue only grow 10% year on year when you compare the first quarter of 2024. Was really bad news because analysts were expecting higher growth, but I'm still expecting 10%. But for me, it's the most important part, and the biggest miss was on the revenue, because Pinduoduo is growing a lot, and it's very important that can grow revenues in their future. So in my opinion, the worst part of this report was this revenue miss. Looking at this earnings report, we see revenues were up an increase of 10% when compared to the same quarter of 2024. Operating profits down 36%. This is very bad, but that's a reason, because they are investing. Pinduoduo is a company that has high returns on equity and high returns on invested capital. So until right now, the past says that they are investing very wisely their money. So if they can invest this money that they are doing with high returns in the future, that they are doing the best, and it will be very good for the shareholders. So I don't mind a lot seeing net income decrease of 45%, for example. Words from the CEO: in the first quarter, we made substantial investments on our platform ecosystem to support merchants and consumers amid rapid change in the external environment. These investments weigh on short-term profitability. Since we are long-term investors, I'm always thinking about the future. I don't care if they have a year where their profits are down. And when we see companies investing a lot, sometimes we see companies not having profits. But Pinduoduo is investing a lot, and still they are very profitable. But gave merchants the room to adapt and focus on high quality, sustainable growth, strengthening the long-term health of the platform. If what they say are true, this could be very good for shareholders, and it's good news. Amid growing uncertainties, that's bad. We see enhanced merchant support as essential to build a healthy merchant ecosystem that can deliver satisfactory shopping experience for consumers. I don't like this. That's my opinion. When you see business that have to invest a lot to maintain their market share or to be profitable, that's not good news. We prefer business that don't need high capex or a lot of investment to maintain their position. There are a lot of competition in their ecosystem, and we are seeing that they are facing competition right now, and they have to invest. So that could be not the best news for Pinduoduo investors, that they have to spend a lot to maintain their position. We'll prefer that these profits could be returned to the shareholders, but if they continue to grow, Pinduoduo will be a very good investment in the future. As communicated previously, a slowdown in growth rate is expected, so that's the point. Pinduoduo has been growing 100% revenues per year, doubling revenues every year. In the past year, they grew 50%. So they will not grow at this rate forever. They are already a big company. So they are going to be a more mature company. Expect a growth of 10%, high single digits, 12%, around that, because they cannot expand so fast as previous, because they are already a big company right now. As we have been saying on our channel, on our valuation discounted cash flow, analysts were expecting 30% revenue growth. For the next 10 years, we are expecting on our base case to Pinduoduo to grow between 8 to 10%, which is a very conservative analysis. Right now, it doesn't look conservative, but a quarter ago, it looked very conservative. But this is the proof that we have been right, and always being conservative always pay off. Is expected as our business scales and challenge emerge. This trend has been further accelerated by change in the external environment in the first quarter. So they are probably seeing or facing some issue with the tariffs. I'm expecting more problems ahead in Q2 because of the start of the tariffs by US government. Our financial results may continue to reflect the impact of sustainable investment in the ecosystem as we support merchants and consumers through uncertain times. So this is the words from management team. Revenues, we have seen 15% growth in their online market service, and in terms of transaction service, 6%. That's not the best result or what we expect to see on Pinduoduo. Another important part is that they remain very profitable even when they are facing troubles ahead, tariffs, and even when they are investing a lot. So that's very good news, and this shows that's why Pinduoduo is a very resilient and very good business. In terms of cash equivalents and short-term investments, they have $50.2 billion. So market cap right now is $146 billion. So they have one third of their market cap in cash. That's a very strong balance sheet. So what they should do with this money, they saying that they are investing, but even when they are investing and facing some issues, they still are printing money, being very profitable, and their balance sheet is getting better and better. So in my opinion, one thing I would like to see in this report would be a start of a buyback program, for example, because at this valuation, with this balance sheet, it makes a lot of sense. But there could be problems. We don't know. Management team from Pinduoduo, they don't talk a lot in their earnings report. That's something that I don't like, in my opinion. But should they be doing, why they are not doing a buyback, for example, or paying a dividend to the shareholders, redistributing their profits, their balance sheet to the shareholders? Probably because of this, if they want to buy shares in the ADR on US, they could not transfer money from China to the US to buy back. They will have to do like Alibaba to raise debt to buy back their shares, and they don't like, or they don't want to do that. Probably Temu is not being very profitable. and they don't have plenty of money outside China to do these buybacks. There are plenty of reasons for them to not do that, but if they do that, it will be value accretive to the shareholders, and that's something we would like to see. In terms of fundamentals, they remain very strong, trading at the forward P below 8, so valuation below 8, and they have 1/3 of the company in cash because they don't have long-term debt, they don't have any debt, they have $50 billion in cash and short-term investment. Their margins are very good. In terms of our money checklist, I'll check my except the one of our key points, that is returning capital, doing dividends or buybacks. If they add that, it's almost 100 score, it's 96, but since they are not paying that, my fundamental score is lower. They are trading close to that. When you look to graphs, they have been growing steadily, free cash flow growing as well. I expect 2025 free cash flow not growing, it will be around 100 billion yuan, I'll expect, but in 2026 and 2027 they continue to grow. Gross margins are decreasing but very healthy at around 6%. Return on invested capital very high, as we like to see. Shares outstanding, it was going up, they were diluting the shareholders, but right now they are steadily maintaining or being flat. I would like to see a very huge buyback from Pinduoduo at this time, so they can boost their free cash flow per share even more. So right now I'm expecting 2025 to not be a growth year, maybe a stable one or slightly below this 2024 mark, but in the next few years this graph is the most important graph. As shareholders, we like to see free cash flow per share continues grow, and they can if they can continue this free cash flow per share growing, it will be a very good investment in the future. In terms of valuation, it's a Chinese company, so there are plenty of risks on that, and in terms of business risk, it's high. I think BAV or GD are safest companies, or it's a safer investment in terms of business. Pinduoduo are facing a lot of competition, and for me it's high risk. So with this analysis, my base case, my discount rate for my base case has to be at minimum 60%. I'm not interested in investing in Pinduoduo if I don't have a rate of return above 16%. So for my discounted cash flow base case, I assume 30% margins. Bear in mind, in the average of the last year, free cash flow margins were 37%. We had 31% last year. So if they resume profitability in the next few years, 30% free cash flow margin, it's very conservative. I'm expecting them to grow in the next 10 years between 10 to 7% in the last 5. So I'm trying to be conservative, and I think they deserve a P of 20, slightly above the mean of the market. So with a discount rate of 16% for my base case, and then I have a bull case where I assume I have a slightly optimistic case. If the Chinese economy booms, Pinduoduo continues to grow very fast and the profitability rise, and a bear case when I'm less optimistic about the business. And with that, I came with an intrinsic value of $142. Right now the stock is trading around $103, so there are plenty of margin of safety, around 30%. Pinduoduo, it's a very good company and business model, so there are some margin of safety, and this could show that Pinduoduo looks very attractive right now. What do you think about that? So to sum up our analysis of Pinduoduo Q1 earnings, yes, the headline numbers caused a shock, and the 13% drop reflects that. The era of Pinduoduo growing at 30% plus consistently is likely shifting. We have been forecasting towards a more modest, yet still solid 10% growth range, especially as we head into Q2 with potentially tariff impacts. However, the key takeaways are crucial. Pinduoduo's core fundamentals remain impressive. They have a fortress balance sheet with about a third of the company's market cap in cash. The valuation is looking very attractive, especially if management initiates a share buyback program that could be a game changer, potentially doubling the stock price to $200 per share. The biggest question mark is why they aren't deploying that cash for buybacks right now. This report highlights the importance of our conservative valuation approach and maintaining a margin of safety. Pinduoduo is still a very good business, but expectation needed a reset. If you found this deep dive helpful and want to stay ahead with our investment analysis, make sure to hit that like button, subscribe to the channel and click the notification bell so you don't miss our future videos. Thanks for watching and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.